I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us. Before we get started, I want to remind all participants the purpose of this presentation is for informational and educational purposes and should not be construed as a recommendation to purchase or sell any security. Do your own due diligence and seek counsel from a registered investment advisor before trading any security. I want to thank the Microcap Club community for tuning into our 27th business breakdowns. The business we are breaking down today is Golconda Gold, which trades under the symbol GG on the Toronto Venture Exchange, under the symbol GGGOF on the OTC markets. Golconda Gold is a profitable gold producer with production assets in South Africa and soon to be New Mexico in the United States. The company is focused on tripling production over the next few years while not diluting. We have the CEO and 30% owner, Ravi Sud, with us today. He's going to take us through the backstory, where they are today, and then where they plan to go. And as a reminder for those of you listening live, if you have a question, and we'll get to them after the presentation, just enter them using the Q&A button on the bottom of the Zoom screen. Ravi, thanks for joining us today.
Great to be here, Ian. Thanks for the opportunity.
I know for a lot of people, the company, really has come out of nowhere, and obviously the stock's been kind of shot out of a cannon as well. But the company's been around for a long time. I think its origins date back to 2010 or 2011, when you founded it. And, I know there's quite a backstory here. So I thought it'd be great if you can give kind of your personal or professional kind of history or backstory, then also Golconda up to this point in time.
Yeah, absolutely. And there is quite a history to it before that predates the assets that we have in the company that are our backbone today. And it is, I think, really valuable to go over it. My background, my career breaks into two halves. The first half, about 15 years, was in asset management in the investment business, ultimately as CEO of an investment firm based in Toronto. I sold that business just over 15 years ago. And the latter half of my career has been focused on Golconda Gold and a few other investments that I've made where I typically sit as a board member and involved in a non-executive basis as a director of the company. The history of Golconda goes back to 2010 when I was approached by a company called I Am Gold. I Am Gold had, of course, a mid-tier gold producer or large cap even these days, and was formed through a sequence of mergers and acquisitions, as many gold companies are. And they had an asset in Botswana called the Mopani Gold Mine that they'd acquired in 2006 for $240 million. And I'm going to mention the numbers of the acquisition cost because I think it's really important to frame the thesis around Golconda and also put hard numbers around the chasm between being an interesting company that has a great deposit and all sorts of potential and one that's actually in production making money. It's a huge gulf. So $240 million, they bought this mine. It was Australian listed asset in Botswana, and gold was $650 an ounce at that time. Fast forward 4 years, and they had about 18 months of reserve left. The mine was producing about 40,000 ounces a year. So in the new IM Gold that had grown quite a bit through mergers and acquisitions, it was a geographically disparate and from a production size, small asset in their portfolio, one that really just didn't get the attention that it deserved. And they contacted me directly and said, look, is this something that you'd be interested in acquiring? We know you've got some background in Africa and you have access to capital. There's an interesting opportunity here. If you look harder at it, it's just not for us anymore. It's too small. And so I put together a team. I had a huge interest in gold at the time and obviously continued to. And so I put together a team to do the technical due diligence, and we definitely saw the opportunity. All the work had been done at this asset with gold at $250. It was built. IM Gold paid $240 million when gold was at 600, 650. And we saw that it only had 18 months of reserves left, but those reserves and all that exploration work was based on work done, $1,000 lower prices. Gold was at sort of $1,600 at the time. So we saw, okay, we can extend this probably at least to 4 years and maybe beyond that and have a very profitable operation. So I struck a deal to acquire it from IM Gold. It was $10 million cash, $5 million note, and a bunch of shares in the new company that was being formed. So you could see that value destruction there for IM Gold. Nothing, it's a great company. They didn't do anything wrong. But again, you had a company purchased for $240 million, and now I'm buying it for $10 million cash up front, a $5 million note, and some shares in a new company that otherwise had no assets. I subsequently bought with a group of investors IM Gold's entire stake out for a relatively modest price. And we extended that, in fact, 11 years. So it wasn't 18 months, it wasn't 4 years. We managed to squeeze 11 years out of it and produced 332,000 ounces for Golconda Gold over those 11 years. And another important takeaway from the story, Ian, is we didn't make any money from that. So we our all-in cost over that time frame was below $1,400 an ounce, and we received less than $1,400 an ounce for those 332,000 ounces of gold. Obviously, if we had a time machine, we could bring those ounces forward to today. In today's gold price environment, the cost would be a little bit higher, a couple $100 an ounce, but the gold price completely different. So important takeaway, we sold that asset. We pushed some debt off our balance sheet, but we sold that to the local management team when we felt it was getting very close to the end, or it would have to dramatically reduce its production profile to keep going, for $1, and the assumption of about $18 million of debt. So acquired for 240 million. All sorts of good people around it. More money went into it. Produced some ounces, didn't make any money. Sold for $15 million plus some shares, and then sold for $1 plus assumption of debt. Uh, Very difficult to make money, and that was with an operation that was already built. The mill was in place. Very challenging. But in terms of creating the company Golconda, critical asset for us, as it allowed us to form our team. We cut our teeth on that. We had to survive through a half decade of declining gold prices and constantly adjust our cost structure to accommodate that. We really developed a way of operating that got us through that. And through that whole time period, at no point did we raise a dollar to keep Mupani going. We were able to run that mine and adjust to the lower and lower gold prices from 2011 through to 2016 without raising any money. So that really defined and created the DNA and what the company that you see today. The other thing that it allowed us to do was to acquire two other assets. So not dissimilar to what we did with Mupani, buying an existing mine from an operating company. We acquired the Galaxy Gold Mine, our principal asset today. That was out of a restructuring process. So again, defined resource, existing processing infrastructure, existing mining infrastructure, lights, offices, ventilation, roads, all the basics, and purchased for nominal consideration. We bought that December 2015 for, I won't go through all the details, but it was nominal consideration in the context of where it was in a restructuring and where the gold price was. We also, at the tail end of COVID, I'll say, acquired the Summit Mine in New Mexico. Again, past producer, mill, all licenses in place, all the infrastructure in place. Nothing really went wrong with the mine other than it had too much debt and a royalty and a stream and all those goodies layered on top of it when the commodity price started to fall in 2013 and the gold and silver price fell off a cliff. So they weren't well set up for that. Good asset, small, but the capital structure is what brought that one down. So again, we bought something, I think, very well and very timely, lower gold price, kind of a distressed environment with around COVID, and a mine that it's not worth anybody who is just an explorationist, because the real value there was that it had all these permits and the milling infrastructure and underground mining infrastructure, and you had to be a miner, but it was small. So not of interest to Kinross or Newmont. but of interest to somebody just like us who does underground mining, can take on something like this, and it can move the needle for us. So it was an important acquisition for us. So that's the company. So it's an overnight success, but with 15 years in the making. Really, the first 10 years of which was cutting our teeth and developing this operating ethos and DNA around the Mupani mine in a declining gold price environment. And it's set us up as a really lean and mean company that's now able to benefit from that as we bring the production up at Galaxy gold mine and are about to restart production under our banner at the Summit gold mine in New Mexico.
Well, thanks for that overview. Why don't we go ahead and let's go through the presentation, and then we'll get to some Q&A at the end.
Absolutely. Let's see here. There we go. So just very quickly on the capital structure, I think this is something worth highlighting. We have a very unusual capital structure for a company like ourselves. Mining is a capital-intensive business. We've taken a different approach, which is, as I've outlined, buying past producers with existing infrastructure in place. So on the other side of that chasm of the huge capital investment and that huge execution risk and exposure to the cycle while you do it. So that's meant that we've had to invest less on the capital side. We've also by virtue of the fact that we've just been around and listed for a long period of time through, I'll call it a dark age in junior mining, where absolutely no one cared. Management team and myself in particular has been the buyer of last resort or only resort in the marketplace for a long period. And as a result, myself and my family and a couple other insiders, directors, and management team members own over 40% of this company. So really unusual capital structure. I think that's more important in this mining sector than any others because of that capital intensivity and the trend. Like I'm not casting any stones. Like we all obey the laws of physics. If you don't own much of the company, then you have to make your compensation from your salary, from figuring out how to get lots of options. That's just the way things work. And that is not completely aligning management teams with investors. In the case of Golconda, I might make the wrong decision, but it's for sure you can bank on the fact that any decisions that I make or the management team makes are in the interest of the long-term value of the shares, not the short or medium-term value necessarily, but definitely the long-term value. We have no prospect or interest in getting out in the short or medium term. So the decision making here is like, how do we create long-term value for ourselves and all the other shareholders as an extension of that? Of course, people get paid a salary, but that's inconsequential relative to the value of the stock to us. Just very quickly, a highlight on the two assets. Galaxy in South Africa, that's our principal producing asset right now. There we have a 50,000 ton per annum plant. The mill is completely new. That's about quadruple what we're putting through it right now. And we built that. There was kind of a diseconomy to building anything smaller. So we built it right from the get-go to the ultimate capacity that we think we'd use. The good news about that is very little has to happen there. Of course, other aspects of the plant, we have to upgrade and increase the throughput as we expand increase what the tonnage that we're putting through it. But the big piece, the mill, that's done, and that's good. That's good to go for what we intend to put through this over the next 10 plus years. This is a really historic asset. Really one of the first this area is one of the first areas of Africa mined by Europeans for gold. And it's got a 150-year history. So on our property, the first area that was mined goes back to the 1870s. So almost continuously producing gold over that time period. But through a combination of reasons, most importantly, different periods of declining gold price, this asset found itself in a restructuring process, and we picked it up December 2015. Huge resource there. It's over 2 million ounces of compliant resource measured, indicated, and inferred. And so we get a lot of questions. Can you extend that? Absolutely. We can increase that significantly. And I'll say also add to that, it's be largely academic. So if we could increase it to 3 million or 4 million ounces, I think that looks great. But candidly, it doesn't really change our mine plan. So we have a ramp up. As I go through that, your first reaction may be that why is the ramp up so slow? The ramp up is what it is. It's based on the configuration of the ore bodies, the existing infrastructure that we have, and following a very capital light plan. We're doing it in a way where we're generating free cash flow along the way. There should be no quarter at these gold prices where we're not generating profits in excess of funding all of our capital expenditures and underground development, and quite a bit of profits. And we're not racing to show a big number of 100,000 ounces a year. We're maximizing this for the net present value and basically the long-term value of this asset. What can we do here? And this is a very long life asset. This mine will be producing gold long past anybody the lifespan of anyone on this call. New Mexico, the other asset, great one for us. As I alluded to, past producer as a standalone company in the last cycle called Santa Fe Gold. It had over 100 million US market cap at its peak. And a year after that, it went under as we saw silver decline 50% and gold go down quite dramatically as well at the same time. So this is a gold and silver producer. This one is not producing yet. We intend to put it into production starting in Q2 of next year, 2026. And very little work, basically nothing more to do on the processing side for us. And on the mining side, we're using a contract mining approach. So really, it's a mobilization of the mining contractor, some additional staffing, waiting for some notice periods to go through, and also putting ourselves as Golconda in a really stable financial position, which we're comfortable that we'll be in Q2 to self-finance this and not have to issue equity. And I hope not have to, take on any additional debt in order to put this into production. So again, talking about adding production, usually big capital expenditures, permitting risk, timing risk, execution risk, none of the above in this. So of course, we have some execution risk. It's never zero, but no, essentially no permitting risk, no financing risk. Taking those two out removes most of the timing risk, and we're down to execution risk, but past producer and very high grade ore body. What are the positives? I listed the main ones, also the grade here, also very helpful. What are the negatives? It's a relatively small producer. It'll be doing 1,000 ounces on average per month, gold equivalent ounces, in a relatively short life, 7 years. Now, this one, if we harken back to what we did with Mupani in Botswana, the IAMGOLD asset that we purchased to create the company 15 years ago, it's deja vu all over again for us. So the geological work that was done to create the Summit Mine was done around $650 gold. And there's a lot of data from there, stuff that was walked away from because it wasn't interesting or economic at 650. It's going to be I mean, I can't make any statement. It's not a compliant, report yet. But you can imagine with $3,000 plus gold, stuff that wasn't interesting, but was, showing gold and silver at 600, it's now very interesting. The ore body that comprises the mine currently is open upwards. It's open at depth, and we have 2 zones along strike, which are very promising. So I have a high degree of confidence that this is not a 7-year mine life. We'll be able to extend it quite dramatically and make this a long life asset as well. Probably at lower grades than we're going to be mining for the first several years. That's okay. The value of the permitted mill and tailings facility here in New Mexico, notwithstanding all the positivity around mining in the United States right now, still a very scarce and very, very important asset. So just highlighting, recapping some of the key points I already made. Why are you looking at Golconda Gold now? So first of all, if you have a view on gold price or you like where it is right now, we're actually producing gold 365 days a year. So while everybody in the sector benefits and the rising tide floats everybody's boat, our financial statements are the beneficiary of the gold price 365 days a year. So we're actually making money off of it day by day. Number two, we've got organic growth. We're kind of, coming in round numbers, 10,000 ounces for 2025 is the guidance that we've given. We have the ability to basically take that up 5x over the next 5 years in very clearly defined steps, increasing tonnage, opening new faces at Galaxy, all that with the existing plant and milling infrastructure. So again, that's self-financed. It's all being done organically at Galaxy. And even at that throughput, virtually quadruple, it's over 3 times anyways, what we're doing right now. Very long life asset, lots of resource there to go at. And by adding that additional 1,000 ounces on average per month from Summit, opening up a new jurisdiction for us as well. And finally, just again, the insider ownership. This is us being aligned with the investor. So, we're not immune to making bad decisions, but we're doing our best, and you can bet the decisions are being made with the interest of the share price first and foremost. Just a little bit more detail on Galaxy. This is a cross section. These things are confusing at the best of times, but it's a constellation. There's actually now 23 ore bodies. We're currently only mining at 2 of them, Princeton and Galaxy, and we're mining at 3 faces. And so what does this mean? It means we have a whole bunch of additional ore bodies to go at. They're pretty well understood. One of the things that had constrained this asset historically was that this gold is refractory, which means it's chemically bound. It's hard to actually extract the gold from, and it's not economic to do so from a conventional process like a CIL plant. And you would get very low recoveries, really punishing the economics of mining gold and processing it in the typical way. What we did to unlock that, which is now not an exotic method, is we produce a concentrate, which is, we take the refractory ore, we produce a concentrate that then gets shipped. We truck it a couple hundred kilometers to Durban in South Africa, and then it gets taken by an off-taker to an overseas smelter, and it gets processed there. We get paid round numbers. There's a formula, and it moves up and down depending on grade and moisture levels and a number of factors, but round numbers, 80% on the contained gold. And why is that a good number? Well, if you had a conventional CIL plant, you're processing the gold-bearing ore that you're mining. You're typically going to get something like 90% recoveries, maybe 92% recovery. So you're getting 90 or 92 cents on the dollar on the gold that's contained there, better than the 80 cents on the dollar that we get. However, you also had additional CapEx for that plant, substantial additional CapEx. You have additional OpEx for that more complex processing. And you do have further execution risk and variability around that, certainly. And it would be not unusual to see 5% swings in that recovery. So reducing the CapEx, reducing the OpEx, and reducing that execution risk were all important things for us, and allowed us to unlock this refractory gold deposit and access these additional ores that otherwise, if we went back 15 or 20 years, would have been considered uneconomic virtually at any gold price. So huge opportunity here to just keep going. Great analog for us is a very similar deposit. It's about 30 kilometers away. It's called Barberton Mines. It's part of Pan African Mines. It's a London-listed company. It was the core asset that they kind of created that company around. They're sort of, I'll call it 20 years ahead of us. They have the same refractory ore, almost identical geology, and they took that one on, and they've got it up. It's producing this year. It'll produce about 70 to 72,000 ounces. So they've made a larger capital investment over the years, but been super profitable for a very long time for them, and really a core asset that's allowed them to create what's now a billion-dollar company. So great analog for us, showing that it is possible and it's been done before. We're right exactly where we are with a very similar deposit. A few photos here that before and after. So before on the left on the plant, when we took it over, kind of a museum-looking type plant, a lot of old components and buildings there. On the right, largely new and running. And similarly, underground, again, some of the infrastructure here is over 1 century old. So we're the beneficiary of capital investments that have been going on for 100 years. And of course, modernized in a very simple way, adding new equipment, just, typical things that are done in underground mining today, but benefiting from that century-old infrastructure. A few more views here. In particular, in the bottom right, I'll highlight the concentrate being shipped by truck. So it's going out in 1-ton bags, and that's how it travels to Durban and ultimately to overseas smelters or roasters where the gold is extracted. It's a little bit more definition around the ramp up at Galaxy and specificity to it. So where we are now, we've transitioned from Q2 to Q3, going from 10,000 tons per month to 12,000 tons per month. Next year, we are transitioning to get that up to 20,000 tons per month of ore. And that gets us from, again, round numbers. You can look at the presentation more detail and look the more specific guidance, but 10,000 ounces produced this year, going to just under 18,000 ounces next year. So a huge step up. And I'll highlight the fact that we are profitable. You can see our Q1 results with much lower gold prices and lower production profile. Q2, slightly higher production, significantly higher gold price, generating a lot of free cash flow. And Q3 and Q4 this year, we'll see an even higher gold price and higher volumes. The listener can extrapolate what that should mean in terms of cash flow generation. And then we're lifting that another 80% in 2026. This is all organic, existing infrastructure. Don't have to do anything on the processing side. Just need to get more tons from those faces underground. That then ramps up in the coming years, adding additional tonnage and throughput. Why isn't it faster? Why can't we get to the ultimate goal of 40 plus thousand tons per month before 2028? It is possible. It is not, in the view of management, the best risk-adjusted use of capital. So again, we could get on that same flywheel and try and get to a bigger ounce number faster and check some sort of box with the market. I assure you, if I thought that was the most profitable and valuable thing to do for this company in the long term, we'd be trying to do it. But we don't think that's the case. We think doing it organically, doing it over cash flow, generating free cash flow the whole time while we're doing it on a risk-adjusted basis is the right thing to do, and that's the plan that we're on. Slow and steady wins the race, I guess, would be the summary there. Here's some more specificity. This is our guidance on production ramp up going forward. So you see that 10,000 ounces this year going to 18,000 ounces. You can also see the free cash flow number for 2025. And these projections are based on $3,000 an ounce. So we're most of the way through 2025. So, you can see the cash flow generation potential of this company at $3,000 gold with a very modest production base. The AISC, you see the big drop, particularly in 2026, and that's the fixed cost component of the business. So again, modest production base. Now those ounces being amortized over 80%, the cost being amortized over 80% more ounces year over year. That's your first big step change downwards in the all-in sustaining cost for the ounces we're producing here. So again, this is we've got I think a flat 5% inflator there on costs. Maybe it's more, maybe it's less. But I think this is a very good indicator for investors to look at, and they can see that while it's still a modest production, the pot of gold at the end of this rainbow is pretty big with $3,000 gold, and it's a very good business. Interesting question that we get from a lot of investors with some eagle eyes is, why is your free cash flow not going up more in 2027 and 2028 versus 2026? That's because we are, by the end of 2026, fully taxable. We have a large tax pool that we're burning through. So a lot of that free cash flow that we're generating, we're not It's because we're not paying tax in 2025 and for a big chunk of 2026, and also align their minority interest. So this is something unique to South Africa. South Africa is, a country that's revolved around mining for 100 plus years. Really huge amount of the innovation and know-how in the global mining industry has come from South Africa for a very long time. Um, and one positive thing we can say is like there's not a history of nationalizing assets. The mines have been there for 100 years, and the government doesn't take them away from you. However, there is a component which is called the Black Empowerment Program, and we do have 26% of the mine, any mine, has to be owned by previously disadvantaged people. In our case, it's a trust that's set up as a microfinance institution funding solely female entrepreneurs in our region. And once we've gone through all the intercompany debt, recouped all our capital with interest, paid all our taxes, to get money out as a dividend from the operation, this is after capex, sustaining capex, after taxes, after everything else that we've paid, royalties, etc. Then we have to take the money out as a dividend, and of course, then we're only getting 74%, and so 26% of that cash would come out as a dividend to the Black Empowerment Group, and that's the minority interest line. So as our cash flow grows, it does go a little bit sideways, 26 to 2028. It's because we're fully taxed and we're assuming dividends going out to our Black Empowerment partner. Just a little bit, these are our internal calculations. This is not done by an external source, but it's really based on the guidance in the spreadsheet on the previous slide. Again, $3,000 gold. This is fully taxed. NAV per share is substantial, huge premium to the current price, and you see the leverage there. So as we go up to $4,000 and $5,000 gold, the numbers get big. And again, this underscores our thinking around this. Why are we not racing to try and increase it to 40,000 ounces right away? Why aren't we trying to expand the infrastructure so we can do something more like the mythical 100,000 ounces? We don't need to. The prize is big enough doing it the way we're doing it, and the risk is much lower. A little bit of information which you can learn about from the presentation on our website about the Black Empowerment Group that we are teamed up with as our partner. As I said, it's a microfinance institution focused on female entrepreneurs. Summit Gold Mine in New Mexico, a bit of a different beast, but a lot of similarities here. Existing plant, underground mine, also producing a concentrate, but starting with a very high grade and a relatively simple operation. So one, we have a lot of confidence that I'm sure there'll be hiccups as we're restarting it in Q2 and brushing off the cobwebs. It's not going to be linear. It's mining. There's always, if you write down 99 things that you think might go wrong, it'll be the 132nd thing that you didn't even think of that actually goes wrong. So there will be issues on the restart. And as a result, we've got quite a modest forecast for 2026, which we'll hit in a second. But this is a big one for our company. I think, notwithstanding all the positive aspects of operating in South Africa and the very long operating history of mines there, there is a discount or a lower multiple placed on cash flow coming from Africa or South Africa specifically. Having an operating asset in the United States generating free cash flow has been very well received by investors, and we're very excited about getting Summit going and growing. Plant, very simple process. Again, this was one that was running. It was successful, and what really brought this company down was the commodity price decline in 2013, coupled with a very fragile capital structure. So if the commodity price had stayed high, they would have skated through. If they had a more basic, robust, resilient capital structure, they could have skated through, but neither of those things happened. So enter Golconda Gold, and an opportunity for us after it sat for the better part of a decade on care and maintenance, but in semi-arid desert-like conditions. So very little damage done, and the equipment in very good condition. Typical underground mine, and won't go into much detail here, but as we did discuss previously, there is a lot of exploration potential here. So much like we did with Botswana, we're going to extend that quite dramatically. So what are the key milestones to look for right now is, we're continuing to go through sort of different regulatory steps that in Hidalgo County in New Mexico and at the state level. Make sure all appropriate notices are posted. All the stakeholders are informed that we are restarting. A lot of courtesy visits occurring and making sure everybody's on board and aware of everything that's happening. We are also doing a new resource report for Summit. Again, this is not based on any drilling. This is really just looking at the ore bodies and all the data that exists already in the context of a much higher commodity price and a different gold-silver ratio. So remembering it's gold and silver in this ore body, where that ratio is does dictate, do you go more towards gold or more towards silver? And those assumptions are important to that exercise. Also, more detail on how we're going to finance this internally. I think with the current gold prices, we'd be in a strong position to just finance it with no external financing whatsoever. But the one key commitment that we are making is we will not be doing anything dilutive, no convertible, no equity issue. We don't need it. It was always the intention to wait until we were in a position to bring this on. And if it meant waiting another year or 2 years or 3 years, that's what we would do because, the exercise is to make the shares worth more over a long period of time, not to add ounces. So here we are. We've got the gold price. We've got our core operation working and generating free cash flow while it's ramping up. We've substantially improved our balance sheet. We've paid off our line of credit with our off-taker Ocean Partners. We do have some remaining debt. All of that will be repaid in March of 2026, and we'll be entering Q2 of 2026 debt-free with no historic accounts payable, generating free cash flow, every day of the week. So we'll be, if we trip up, and it takes us a couple months longer to get Summit, going at the rate and the volumes that we need to make it a profitable operation, we're fine, because we have Galaxy there to support us. But the ramp up, pointing a new resource report, a revised mine plan reflecting the higher commodity prices and different gold silver ratio before the end of this year, done by an external consultant, and the appointment of a mining contractor in Q1 and commencing mining operations in Q2, with production no later than Q3, but hopefully having some of that production fall into Q2, even if it's just nominal, and achieving full throughput within the first 12 months of operation at Summit. What does Summit look like? So again, as I mentioned earlier, very modest assumptions for 2026 as we get going. Just wanted to make sure that we had some room for forgiveness there. I think that's a very achievable number for 2026. And the interesting thing is, even with that nominal production, with all the overheads allocated over a tiny number of ounces at today's gold price, it'd still be profitable, and could be generating free cash flow even in 2026. So again, small number of ounces, but if you're not hung up on the number of ounces and your focus and your interest is in cash flow generation and profit, there's no CapEx. There's no big gulf to jump across in terms of financing, permitting, and execution risk. We're into cash flow basically right away. So small, sweet, beautiful is Summit, and a lot of potential to extend this. Won't be huge numbers. It's never going to be producing 100,000 ounces a year. But I'd like to think that under any realistic gold and silver price scenario, this one's going to be cash flow positive and contributing to our company. NAV per share, a little bit more modest than Galaxy in terms of its contribution to Golconda. But again, fully taxed and pretty big numbers. Even remember, this is just Summit. at today's gold and silver prices. So a lot of reason to be excited about bringing this one on, and especially with it being located in the United States. I won't go into much detail again on this, but there's a lot of exploration upside. The key thing to remember is the work that was done, the feasibility work before this mine was built. Gold and silver, gold price was $3,000 lower. It was $600 an ounce. So there's more gold and silver here, and we've got lots of stuff to start with. It's not a cold start on finding where it is. We know where it is, and we know where to do the exploration work. We're not going to spend any money now. We're not spending any money in 2026. We will only spend the money out of our free cash flow to extend this. We're just there's no race. We know when we need the additional ore, and we've got lots of time to find it and do that on a completely de-risked basis out of our own cash flow. This is, is something that's on the table for discussion, and it will be very much dependent on where the market is at the time. But there is, we have considered the possibility of spinning out Summit as a standalone US-only gold and silver producer, which would make it either an interesting acquisition target for other US companies or a potential consolidator that it can act out of, being in its position of being profitable and getting a premium multiple for being US only. If this is not advantageous for Golconda shareholders, the largest of whom is me, we will not do it. If it is advantageous and the market is really hungry for an opportunity like this and the valuation is extremely compelling, we will do it. And we've set the structure in place to do this on a very tax-friendly basis if we do proceed with this. So just, on a pro forma basis, compiling the ounces, I think, the top few rows are guidance on production here going forward. You see the ramp up, so we get to that temporarily to a little bit of a blip with a big production lift in Summit in 2031, but really sort of peak into the 40,000 to 50,000 ounce range. We have that tailing off in 2033 and 2034, assuming that Summit is no longer producing. That won't be the case. Like, as I said several times already, we'll extend that dramatically. But in terms of what we have with the compliant resource right now, this is the current mine plan. So we're assuming that it tails off. But you see that huge ramp up and what it means for our cash flow as a company at the Golconda level. Again, fully taxed and factoring in the minority interest at the Galaxy level. Huge leverage here for Golconda to gold price, and more of the contribution from Galaxy. But yeah, big numbers. So again, we don't have to race. The prize is huge. Doing everything on a risk-adjusted self-finance basis is the best way for us to proceed. It's worked. It's got us this far, and it's going to get us to the next step and the step after that one. So again, just summarizing what are we doing to create value here? Continue to self-fund Galaxy and ramp up the production there, generate free cash flow as we're going. Number two, get Summit restarted. Number three, if it is a compelling opportunity market-wise, the valuations are there, spin out Summit or not. And finally, when we have nothing else to invest in internally, it would be really nice to get a dividend or to repurchase shares. I've been a big fan of share repurchases in the past. That is a function of valuation. If we're trading at a modest multiple of cash flow, it's a better use of capital to buy back shares. If we're at a huge premium multiple, it makes more sense to pay it as a dividend. The reality is we're capped with a normal course issuer bid at 5% of our free float. And so it could very well be both, where we're maxing out our buyback on an annual basis and paying a dividend. But again, it's very much a function of the share price. So we'll see where we're at 3 years from now, when we're in that position where we've completed our internal investments and able to just look at that as truly free cash flow that we need to return to shareholders. That's our key team. I think given a bit of my background, I have served as a director of a number of other companies across a variety of sectors, but also in the mining sector, Phoenix Coal, which is a company that we sold, Elgin Mining, was sold to Mandalay Resources. a variety of software, semiconductor, and agriculture companies. Again, exits on basically all of them, as well as the renewable energy sector, Jade Power, Buchanan Renewables, also both companies that are sold. So important to note that most of these investments I'd gone into as like forever investments, and companies that I'd hoped to be involved with for an extremely long time, legitimately. And in every case, I've ended up selling the company or being part of a sale process because it was the right thing for the company in all those cases. And if there's more than a few tears shed in some of them, is they're really great opportunities with great people involved, and on many levels didn't want to sell them, but numerically, mathematically, shareholder value wise, it was the correct decision. So, will Golconda ever get sold? I hope not, but if it's if the opportunity is there and it's the right thing for shareholders, again, I'm the biggest one. It's something that we could, we'll make the right decision for shareholders if that opportunity ever presented itself.
Thank you for the comprehensive overview of the presentation. Really appreciate that. We had a question come in, and I think you hit on a couple. I think you hit on this somewhat, but maybe if you want to talk a little bit more about it, is just, is there any jurisdictional risk when operating in South Africa? Just getting things done, getting, additional permits granted, like things of that nature.
I'd say it's in the context of Africa, very low. And I've sat on boards and been involved with companies in, I don't know, 5 or 6 other countries in Africa. Usually the issue, for example, say the Congo, is the biggest issue is not worrying about nationalization, or I'll call them macro issues. It's micro ones, like how are we going to get our equipment in? How much is it going to cost us? How long is it going to take? Usually the equipment that you're getting in, whether we're in Congo or in Liberia or what have you, was coming from South Africa. So it's totally different. And for those, there's just not that many people out there, but for those who have spent time in Africa and visited different countries, they would know that the infrastructure in South Africa is just sort of on an island unto itself in the African context. Where we are, the roads are all paved, and I'm fond to say it's hardly the hallmark of civilization, but we do have a KFC and a McDonald's in town, like where our mine is. So we're not out in some hinterland, exotic locale. It's beautiful, but it is not remote. It's an hour drive from the airport that you access to visit Kruger National Parks, or on most top 10 lists of best national parks in the world. Um, very, very pleasant place to do business. It does move slower, and with a little more variability than, say, Canada or the United States. No question about that. But there is no history of nationalizing assets in South Africa. There's occasional chatter about it. The knock or the negative is that minority interest, that you do need to have that 26% Black empowerment partner, the previously disadvantaged people, and that you got to factor that into your numbers. But because that's there and that's been a successful program, or at least partially successful, I don't know that it's achieved its original intentions or objectives from 30 years ago or whenever it was put in place. But it's meant that there has been that component for the local population, and there hasn't been like this sort of history of nationalization. Uh, Going back to my earlier point, the micro issues that are the very real issues when you're operating in most of Africa, because day to day you're not worried about this, big, some big guy in the government doing something really bad to you. You don't have them in South Africa. Most of our stuff is domestically manufactured, and we just drive it to our site. And we have to drive our concentrate 200 kilometers to port. It takes a couple hours. It's all on paved roads and going 100 kilometers an hour most of the time. So the infrastructure there is good, and it's of course, would it be better if it was in Canada or the United States? Okay, probably, but in the African context, it's very good.
Excel spreadsheets and tables always make execution look easy, but we know that there's nothing easy in mining. I'm just curious if you just talk about some of the challenges that you're currently facing.
Yeah, it's we've been very hesitant to put out any guidance, and as a result, to just really stale materials in front of investors for a long time, and that was a function of us having failed to deliver on timelines that we had indicated. And why was that? Why did we fail? The benefit of hindsight, because number one was the financial condition of our company. So we'd, rightly or wrongly, now it feels like rightly, but for most of the last 10 years, it felt like wrongly. We were quite fanatical about not diluting. And so, in as particular, as I own more of the company, I became even more fanatical about it. The downside of that is it really left us in a precarious financial position for much of our history and short of capital in every sense. So we underinvested in our operation. Our equipment was too old. We didn't do normal course maintenance, very obvious stuff, just for preservation of cash and to keep the lights on, figuratively and literally. And our operations went sideways or even backwards as a result. So we were just operating to stay alive. So that cost us in terms of time. And, sure, it has worked out because those ounces of gold that we left in the ground, we're now selling for, it's kind of the opposite of our experience with our previous asset, where we were great at getting the ounces out, but the gold price wasn't there. It took us too long to get to this ramp up at Galaxy. We did not deliver on our original plan. But the universe saved us because the gold price, now that we are delivering on it, the gold price is higher. Not a coincidence either. This higher gold price has helped us fix all those previous underinvestments and catch up on everything very quickly, and with no dilution. So that's why I said, with the benefit of hindsight, it looks like rightly, but it felt like wrongly for a very long time. So let's look at it today. What are our challenges? I'd say first and foremost is equipment availability, and we are significantly below industry standard currently. And our budget is based on us continuing to be below industry standard. That is not someplace that we want to be, and it again puts us in a poor position. We're not maximizing the returns on our capital investments if we're below industry standard utilization and availability rates on our equipment. So it's something we have to fix. So it's straddling, issue/opportunity at this point. So because our assumptions and our performance is based on poor performance in this regard, it's an opportunity. Because we're continuing to have poor performance in this regard, it's a risk factor and a challenge. And it sounds like the simplest thing in the world to fix. Why do you have poor availability? Why don't you do something about it? Uh, we are doing something about it, but it's not an overnight fix. So you have to go from a situation that we have now, where we have a variety of different equipment vendors, machine types, um, different vintages. So we have to stock spare parts and critical spares for a variety of vendors and different machine types and vintages. Then we have to train mechanics on a variety of vendors and vintages, so they don't have as much training as they should or could if it was really zeroed in on one particular equipment type and vintage. Um, all this adds up to contributing to below industry average performance in this regard. It is fixable. It takes capital and it takes time. We now have the capital, and we're making those moves. So we don't it's not fixable in a quarter or a couple of quarters. It's a multi-year effort to improve the training on the maintenance side, the mechanical side, and change over those the fleets of mining equipment. It's not discovering fire. It's not some huge innovation here that we have to do, but it's something that we have to sort of just execute on over the next couple of years.
You have production payable ounces going from 10,000 ounces to just under 18,000, I believe, next year. What needs to happen? How should investors think about that? Is that a bull case scenario, or is that a base case? And what exactly do you have to execute on to increase those ounces?
Yeah, it's not we have a very specific mine plan based on the where we are in underground development and the nature and shape of our ore bodies. So there isn't huge upside to that plan to say, we're not going to produce 20,000 ounces. Uh, I'd like to think there's not much risk of us underperforming by a couple thousand ounces either. So we're going to be pretty close to that number, up or down. And what do we have to do to execute on the processing side? I would regard as relatively low risk because we're still not even pushing our existing infrastructure at the plant and mill. So that's unlikely to be a major issue, not impossible, but unlikely. We have to significantly increase the tonnages that we're moving through. By the exit of 2026, virtually double what we were at Q2 of this year. So the ramp up has already started with Q3. So we've opened up a third location, which we refer to as Princeton Top. That's been largely on track and on budget since we started in, I think, May 1st. And we're opening up another new area to get those tonnages, and we're gonna have to increase tonnages from all four areas to get the numbers that we need for those numbers in the production numbers in 2026. So that's the thing that we're really focused on, and I'd say the risk um, in the plan is can we get those tons up month by month over the next year that's ahead of us? And sounds like very basic stuff, but that's the major execution risk for us.
We had a question come in. Is there any price point on gold where you would decide to hedge?
Um, so we do just very short-term hedges, like we're talking about 2 weeks. So sometimes we do sell. It's very hard to do that without effectively trading gold. So if I'd say, okay, I think gold's a little bit higher, I'm going to sell forward a little bit. That's me making some sort of trading decision on gold. That is not what we're out to do. This business needs to be sustainable under any realistic gold and silver price environment. So what we can do to make that happen is increase our volumes, lower our unit costs, and make sure that the fixed costs that we can't do much about getting any lower are amortized over the largest production base possible with what we've got. So those are the things that we're focused on. Um, Even if we somehow miraculously were the best gold traders in the world and could like pick a top or bottom or something like that in gold price, it would be a one-shot thing. I mean, you gotta the operation has to be sustainable to be a real business. So I'm giving a very long answer for a simple question. No. Other than just like extremely short-term ones, which are really just sort of cash flow management decisions, not trading or hedging decisions. We would have currently in the foreseeable future no intention to hedge or call or do anything exotic or clever with the gold price.
Looking out 5 years, where do you hope the company and business is? Obviously, we have no control over the price of gold, whether that's at 10,000 or 2,000. Obviously, we hope it's higher for your case and ours that own the company. But what do you hope to achieve over the next 5 years?
So the base case is the two mines that we've got. So we've got this ramp up at Galaxy. So if we can complete that, we've really done something and created a great company there. Summit, I think this is another huge opportunity for us to take it from something that can generate cash flow, get into production with relatively low risk and almost no capital to quite a long life asset that's very interesting and as part of this business for a long time. Uh, Again, at modest production rates, but really it'll turn it into a long life asset. So the base case for us is, we already have a lot of growth organically over the next 5 years. Don't have to do anything else. That's the base case. So we're just focused on those two things. If we've accomplished that, I think we've done something great. And if gold's at $2,500, obviously it's less exciting than if it's at today's price or higher. But we'll still be quite profitable at that price. And 5 years from now, I'm still going to own the exact same number of shares, if not more. I need to think about that. Like, what is it going to be worth if gold's lower, and spend more time worried about that. Gold's higher. I mean, great. That's it's if we're doing our job, it's going to be a fantastic scenario. I don't need to waste much time losing sleep about higher gold prices, though.
Well, I think it's one of the things that I was drawn to about kind of your plan is it's a rather methodical organic growth story. There's no, we're going to take these huge swing for the fences and risk, as an exploration play, trying to drill out the next 5 million ounce deposit or the next 1 million ounce deposit. You already have the assets that it takes, and it's really a production play, a cash flow play.
It is, and but it's not lacking in leverage to gold. Like if somebody's out there and is a super bull on gold, which I am, by the way, this is a great vehicle for you because it's the rising tide will float all boats. If you're in the sector and gold's flying, your shares are probably going to go up. They might even go up a lot. But our financial statements are the ones that are really having a party with the higher commodity price, and so that makes me happy, and it's it's going to be a great press release every quarter with those high commodity prices. Uh, we have direct leverage to gold, and it's a lot. So there's no lacking in excitement and sex appeal to the story from that perspective. But I just the whole exploration thing is it's there's a real romanticism and like anything's possible, right? You might just find and amazingly in my life anyways, I've been involved in one company which I had nothing to do with the management of, just as an investor, where they made a major discovery and the value creation was astronomical. So it's kind of like the guy who goes to the casino and wins once and is addicted for the rest of his life. There is that issue with exploration in the mineral sector, but it's not a real business. It's very dependent on capital markets, and it really is a lottery. And the more time you spend with geologists, it feels more like they went to school at Hogwarts than at a like a real scientific university or something. That's how to find these things. I was once on the board, at Elgin, where I was on the board of directors, and we purchased a past producing mine that was once operated by Kinross in Nunavut in the Canadian Arctic. And you literally fly for hours into a barren Arctic wasteland and land on the ice runway. And there's a gold mine in the middle, like, and I just, how did somebody find this in the first place? Like, it's just the phenomenal set of probabilities stacked against you to find it. So I will continue looking at things like Galaxy where somebody already found a lot of gold. Somebody else blew their wad building a huge amount of infrastructure, and I bought it because I waited for the right time and got it for basically a bag of magic beans. That's the real opportunity from a business perspective in this sector. I'm sure guys are going to make a fortune on this cycle on exploration because in many ways you don't need to actually even find anything if you're playing the cycle properly. But it's not what we're doing. We're trying to create a real sustainable business.
Excellent. Well, let's leave it there. Ravi, appreciate the hour you spent with us today going over this story. You have your information up on the screen if any investors want to reach out and get more information. Thanks again.
Thanks, Ian. Appreciate the opportunity.